So this is a very steep curve that you see here on the screen. How difficult is this? There is a McKinsey study from 2016 called Grow Fast or Die Slow. And the study illustrates that how most companies have only a small probability to actually get through these gates, right? Get through these hurdles of the T2D3 growth curve. Here are just a couple of quotes from that study that I think were worth sharing with you. Here's one. Unlike many other industries, if a software company grows at only 20% per year, it has a 92% chance of ceasing to exist in a few years. Why is that, right? 22% seems like a pretty healthy growth rate. The reason is that in SaaS, and in especially B2B SaaS, there is a little bit of a winner takes all dynamic, right? So unless you hit that relatively steep growth curve, it's just very hard to stay to keep track with the other players in the same category. And then another one. Even if a software company is growing at 60% annually, so this is a very high growth rate, chances to becoming a multi-billion-dollar giant, which would basically be a unicorn, are no better than 50-50. So even if you're hitting a really high growth rate, unless you do this a couple of years in sequence and you're hitting it by driving the right SaaS value drivers, it's really hard to win. About 85% of super growers, so those would be the ones that I just described, could not maintain their growth rates for a longer period of time. And once they lost it, only a quarter of them actually recaptured that growth momentum. And those companies that regained their historical growth rate, they had market capitalizations 53% lower than the peers who did not sort of lose their growth rate at some point and then regain it. So these are just some interesting findings in this study. It's data, right? So look it up. Grow Fast or Die Slow by McKinsey 2016. Super valid still up to today.